Hello friends, welcome to our YouTube channel Evergreen Stock Market. Guys, if you want to see this video in Telugu, you can find the video link in the pinned comments. Friends, we discussed about various investments in our previous videos. You can find those videos by clicking on the I button on the top right corner of these videos. Today, we'll discuss about mutual fund investments, its types, how to choose mutual funds, when to invest and when to exit. Also, at the end of this video, I'll discuss about a diversified mutual fund strategy which gave 11% returns before Corona and giving 9% returns during Corona difficult times. So, keep watching till the end. First, let's have a rough look on how mutual fund works. Investors like us will invest their money in a scheme managed by fund manager of asset management companies. They will invest the money into securities like stocks, bonds, gold, etc. The returns generated by those securities will be passed on to us. There are n number of mutual fund types available. To make it simple, I categorized those into three types. Equity mutual funds, which will invest in stocks. These equity mutual funds again divided into different types like large cap, mid cap, small cap, index, sector, etc. Debt mutual funds, which will invest in government bonds, debentures, NCDs, gold bonds, etc. If you want to know more about bonds, you can see the suggested video on the top of this video. And the next type is hybrid mutual funds, which will invest in both equity and debt securities. Now, let's discuss whether these mutual funds are safe or not. Whether it's advertisements or videos or whoever talks about mutual funds, they will definitely mention this point. Mutual funds are subjected to market risk because they are directly exposed to stock markets or other markets. Just because fund manager is managing those doesn't mean they won't have any risk. And these are some of those risks. Equity mutual funds have volatility risk, which means the risk of change of price of portfolio, management risk, the risk of ineffective or underperforming management, and liquidity risk, which is the risk of converting a security to cash without any capital loss. Debt mutual funds have interest rate risk, which is decline in value from unexpected fluctuations in interest rates. Credit risk, the risk of default, and inflation risk, which is the risk of inflation. So, we need to be careful and cautious even while choosing the mutual funds, right? So, let's discuss the various factors we should consider while choosing the mutual funds. There are n number of factors, but I feel these are important to discuss. First one is time horizon and risk tolerance. Based on your risk appetite and the time period which you want to invest, you should select the mutual fund. For example, if you want low risk and less than 1 year, you can invest in debt liquid mutual funds. If you want high risk and less than 1 year, you can invest in equity mutual funds. You can refer this pic for getting the idea. Next factor we should take into consideration is ratings and consistency. Most of us will choose mutual funds based on the last 1 year or 3 months or 6 months ratings. But we should consider previous year ratings as well. Then only we'll know whether that mutual fund is giving consistent returns or not. See this pic. Fund A has 5-star ratings in 2019, but 2-star and 1-star rating in 2018 and 17. Fund B has 3-star rating for all the 3 years. If you just see the latest 1 year rating, then you will definitely choose Fund A or C. But there are more chances they will give less returns in the future based on the history. But if you choose Fund B, it is consistently giving positive returns. This type of consistency will help you to get higher returns in the future. At least get knowledge on the past 5-year performance of the fund before investing. Next, we should consider about AMC and fund manager. Asset management company's reputation, the schemes it is having, fund manager qualification, past performance, fund returns, ratings, everything we need to consider. There are some people who will invest in mutual funds based on fund manager performance alone. Next one is expense ratio and exit load. Expense ratio is nothing but the fee charged for managing your fund. Exit load means the fee charged by the company from the investor at the time of exiting the scheme before the stipulated period. Now let's see why these are important. I'm showing one fund from Zerodha Coin. This is the calculator for 5,000 rupees SIP with expected returns of 15% for 25 years duration. Your returns will be 1.47 crore with the expense ratio of 0.93%, but only 1.18 crore with expense ratio of 2.08%. Just 1% difference in expense ratio costed you a loss of 28 lakhs over 25 years. So you need to select a fund with less expense ratio. Now let's see the exit load of the same fund. Here it is 1%. If you exit the scheme before 1 year of investment, it will charge you 1%. So your investment will be stuck in this fund for 1 year if you don't want to pay the exit load. Next, we'll discuss about when to invest in mutual funds. There is no specific time or right time to invest in mutual funds. If you invest for longer years, you will get larger returns. But should you invest in lump sum or SIP? See this Nifty 50 chart. If you invest lump sum here at the bottom, you will get nice returns over the years. But if you invest here at the top, you will be in loss, right? But if you invest regularly in SIP, you will get a chance to invest in bottom as well and in top as well. So you don't have to worry about the right timing. I will personally prefer SIPs over lump sum investments. Next one is how to invest in mutual funds. Many platforms are available for mutual fund investments. These are some of those: MyCamps Mutual Fund app, KFinCart, Zerodha Coin, ET Money Mutual Fund app, Grow Mutual Fund app, Paytm Money Mutual Fund app, KTrack mobile app by Carvi, and mutual fund websites as well. Now let's see when to exit mutual funds. Most of us who invested in mutual funds will always have a doubt on when to exit this. Whether we are in losses or when we are in profits or during any critical news. But we should not exit in any of those cases. We should only exit only in one of these scenarios. Consistent poor performance of the fund. When the fund is performing consistently poor over the quarters or years, if you don't feel that it will improve in the upcoming future, there is no need of staying in it, right? Then you can exit the mutual fund. Next one is change in the investment objective or rebalancing of portfolio. Suppose you invested when it is a diversified fund, when they were investing in both equity and bonds. But now they are changing the investment to specific sector or equity alone. So you can consider exiting the fund as your initial objective of entering the fund itself changed. Third one is achievement of the personal financial goal. Suppose you invested 1 lakh in risk mutual funds for the returns of 2 lakhs for 5 years. But you got your 2 lakhs by 4 years itself. That time you can take out those investments and keep it in some other funds, or you can utilize it. Last one is change of fund manager. There are many people who invested in mutual funds solely based on fund manager performance. If the existing fund manager changed and you don't have confidence on the new fund manager, then you can exit your mutual funds. So think about all these before exiting. Finally, today's highlight of the video. Mutual funds which gave 11% before Corona and giving 9% during Corona. Most of the mutual funds are in losses during this Corona season because of the sell-off. Now it's Corona. Later, after 5 years or more, we may get some other reason. But if we invest in the mutual funds, which will give consistent returns irrespective of the situation, it will be very nice, right? So let's see those diversified mutual funds. Large cap mutual funds, gold mutual funds, debt mutual funds, technology sector mutual funds, which is an optional. See this Excel. These are the top rated mutual funds in large cap. These are the top rated mutual funds in gold. These are top rated mutual funds in debt. And these are top rated mutual funds in technology sector. Since I always talk about low risk investments, I took only large cap. If you see the returns of large cap before Corona, they gave a maximum of 15% to minimum of 11%. And during Corona, maximum is 6.7% and minimum is the loss of minus 1.67%. If you see the returns of gold before Corona, they gave maximum of 11% to minimum of 9.17%. And during Corona, almost all mutual funds gave around 16%. If you want to know the reason, please watch our previous video about gold investments from the suggested video on the top. If you see the returns of debt funds, it doesn't have much impact during or before Corona. Returns are almost same, but debt funds will benefit from the reduced interest rates. If you want to know the reason, please watch our previous video about bond investments from the suggested video on the top. Technology sector specific fund. They gave maximum of 15.8% before Corona to minimum of 10.64%. And during Corona, maximum of 8.26% and minimum is 3.31%. It's optional whether you want to consider this or not, as it involves high risk. I didn't consider pharma mutual funds, which is giving exceptional returns now, because those didn't give consistent returns in the past. The period which I consider for this data is 5 years. 1st Jan 2015 to 1st Jan 2020 for before Corona case, 21st May 2015 to 21st May 2020 for during Corona case. Now, for our strategy, I am taking the medium returns of these funds. For large cap, 15% is maximum and 11% is minimum. So, I am taking 13% for our strategy, which is the medium. Same like that for all other funds. First, calculate for before Corona case. 13% from large cap, 9.17% from gold, 9% from debt, and 13.16% from technology. The average of all these four funds is 11.09%. Now during Corona, 3.74% from large cap, 16% from gold, 9% from debt, and 7.32% from technology. The average of all these four funds is 9.083%, which is very nice returns as of my knowledge. So please consider this. If you want to select from any of these, please check the consistency of the funds. If you research about all the funds which I mentioned here, you will definitely find at least one or two consistent funds to invest from each of the category. As a bonus, I want to discuss about one more topic. If you see here, these are the top rated mutual funds of large cap, mid cap, and small cap. These are the last 5 year returns of these funds. Large cap gave higher returns than mid cap and small cap. In the last 5 years before Corona, if we include Corona also, large cap gave minimum losses compared to others. So undoubtedly, large cap outperformed the others in both scenarios. Also, if you see the returns of banking sector, before Corona, it gave higher returns than any other sector, which is as high as 20% to a minimum of 15%. And during Corona, losses are equivalent to small cap. If you want to take risk for higher returns, you can consider banking sector as well, along with small and mid cap. That's it for today, guys. Thank you for watching our video. If you like this video, please like, share, comment, and subscribe to our channel for more interesting videos. See you guys in the next video. Until then, stay home, stay safe.